Hey everybody, Doc Severson with you here today, the 24th of January, 2020. ReadySetCrypto Trade School. Welcome aboard. Most of you watching this are going to be watching on some type of replay or some type of archive viewing, and you're going to see the title and say, oh, today we're going to be talking about volume, okay? And that we will. So today's going to be maybe a shorter session. I don't have a whole pile of topics unless we want to bring up something at the end of today's session in the Q&A. Be happy to do that. And of course, if you have a question on anything that I go over today, you can always email me or hit me up in the Discord area, the community of ReadySetCrypto. And that email is support@readysetcrypto.com. You can always fire off a question if you want to. And who knows, maybe I'll use it in next week's session. So without further ado, let's get started here. I am going to bring up the deck. And today, as I talked about, we're going to go over volume, a little bit of volume. So if anybody is live with me here today, let me know if everything is working out okay. It is absolutely pouring where I live right now. We're getting so much rain. 39 degrees Fahrenheit, which is a lot better than where it was when I lived last year, because at this point it would be about 12 degrees and freezing. So everything is relative, right? So today's topic is we're going to be talking about using volume. And this is one of those black arts of trading. And as I talk about in a few minutes here, it's more of an art than a science when it comes to volume. Because really what you're trying to do is you're trying to read the footsteps of the herd and what they're doing. And it's not always the easiest thing to do, and it's not always the most accurate thing, but we do the best we can. Okay, thank you, Betty. Sorry if I got that wrong. Thanks for the thumbs up. Okay, good. So if we had to, we could just trade on price and volume alone. I've said this many times before. Some of my mentors over the years have just been price and volume traders. And what we tend to do is we tend to add more studies and more junk and more garbage to our charts than we need to. And eventually, if you stick around in this business for long enough, you'll probably go just back to price and volume, maybe with just a couple of studies on there. Price, volume, and time are the essential inputs that 99% of technical studies are derived from. I don't know what the other 1% are derived from. I'm just putting that out there to cover me because I don't want to list an absolute, like all of them are based on price, time, and volume. I'm sure some of them are based on something else, but I'm not aware of what they are. So let's pretty much say that just about everything out there is based on price, time, and volume. So if they're all based on price, time, and volume, why can't we just read price, time, and volume to begin with and get our signals from that? If we can trade on price and volume alone, we might have a significant edge versus others that are trading versus lagging studies. Don't forget that most studies are out there based on a linear time frame sample. So in other words, like 14 bar look back or 13 bar look back, something like that, where it's always the same and you're always going to have a lagging signal. You're going to be getting in a couple of days after the actual change in polarity because, hey, I didn't get a positive MACD until 2 days later. Those kind of things. So it's, you use what you have to get started to feel confident with the market. So I'm not going to denigrate all studies. They do serve a useful purpose out there, but I prefer to do price and volume. If you held a gun to my head and said, no studies, I'd be like, okay, cool. I can deal with that. So trading priced on price can be straightforward. If you haven't read the Fractal Energy program yet, if you haven't gone through that, the first half of that is pretty much about trading and getting signals versus price action. Understanding the trend at different time frames, understanding how to plug the puzzle pieces together to form, really it's the first two rules that I trade based on. Rule number one, which is that larger time frames dominate the trend. And it's so easy to forget about this. You get zoned in on your daily chart and you forget that there's a larger trend in place, which is controlling things, which is almost like a puppeteer pulling the strings. And it's easy to get myopic when you just look at one time frame. And then rule number 2 is that reversals happen from the inside out. So the smaller time frames are where you're going to see the reversals in a price trend happen first. And if this reversal is serious, it will start to propagate through larger and larger time frames. So what function does volume provide then? Well, let's go through some uses for volume. So we've all heard this before, more than likely. It confirms the breakout move. So you'll see something happening like this where you'll see a consolidation and maybe even, kind of a telegraphing of that where it's becoming more of an ascending triangle pattern. And then we're going to look for some type of breakout move from there, like breakout. And we should see some, the volume accompanying that. We should see a confirmation of the breakout move with good volume. We'll talk about that in a minute. It can also telegraph a potential failed move. So if we do have a breakout that fails, we might be able to get an indication that it might fail. It can also show capitulation. Although quite honestly, in the crypto market, we don't tend to get moves that go like this, like poosh. That is the typical waterfall decline that leads to capitulation. All the former bulls become bears, and then that leads to the short squeeze. We just don't see moves like this in crypto. And I've got a theory as to why that happens, but it usually happens on the other way. It can show euphoria, and we definitely get these types of moves in crypto. And volume will show euphoria. It can also show divergence. I'll show a couple of signals through divergence in a minute. And so applying volume, I said this before, is very much an art versus a science when it comes to trading. It's very much a black art. So you might find some rules here and there, but what I find is that these rules that are set up, and maybe these were written 50 years ago, don't necessarily apply in different markets. I've seen so many things change in my 15 years in the profession, where it used to be that you could set up volume divergences and trade against those, but you can't anymore in the equity markets because, as we'll go into, you can't short a dull market. So things change all the time, and this is why I don't get too dogmatic about the rules for volume. Now, the rules for price will never change. If you're trading price based on price, it doesn't matter what happens to the trend. It doesn't matter what happens to the character of the market. Really, anything will adapt to price. Price will always be able to adapt to whatever character that you can throw at it. And so what you're doing is following the footsteps of the herd. This is really what you're doing, right? You're trying to look at the herd from what they're actually doing with their accounts. And you're looking for clues as to whether or not the stampede is real with volume. So think about what happens when you get an attempted breakout above a known resistance level. There are many different participants on both sides of the aisle. So let's pretend that we have ourselves some kind of obvious breakout level here. There's our breakout level. And we got bears up here. All right, let's see if we can. This is not easy to do with a mouse, so bear with me. We have bears up here, and we have our bulls down here, and both of them want something different. All right, so if the price is just sitting right here, then we may have a fair amount of what's called overhead supply. There may be some overhead supply, and so this is bears sitting up here with their positions with a sell limit. That would be a sell limit position. So the price has to go a little bit higher. It's a limit order. That means that don't fill me until the price gets up to there. Okay, so that may be happening. And, so the bulls may want to push this thing. Maybe they're buying, and there's more of them that buy, and eventually it hits that level. So the bears want this thing to go lower. They would like to see what's called a throw over, where it pops up here and then the selling overwhelms the breakout demand and it goes right back down in the pattern again. Very, very common to see something like this. Or what you can have is you can have the price completely decimate the bears and get them to immediately turn around and buy back their short positions. And that causes a short squeeze. There's double the demand on that. So there's a lot at stake at these levels, and you can see a lot of things happening with that. So some bulls are hoping that the breakout continues higher by overwhelming the bears, creating that squeeze. And some bears sit right above the breakout level, contributing to overhead supply and hoping that this will be an excellent short level that they can break back down in the pattern again. Others will fit into a gray area. And these are harder to quantify, right? Because there's going to be folks that maybe there were long a position from down here, and then it gets up to that breakout level. They're just they've got a limit order. They've got a sell limit order right up there. So remember, there's other sell limit orders up here from the bears. So this contributes to the overhead supply. And this is why sometimes you'll see the price just kind of banging back and forth inside of a range. And it's because the selling, the overhead supply overwhelms any demand up there and it pushes it back down again. So some of the people that are contributing to this resistance are people with sell limits. They're taking profits. They don't want the drama. They're not sure if it's going to break above. They're not sure if it's going to get faded back down. This is just a purely mechanical play, just to say, look, I just want my fair share. I want to sell into strength. And that's a valid thing to do. It's a noble thing to do. So increased volume at a breakout level shows that a battle is taking place and someone's in pain, right? If you got volume, that means that somebody's getting spanked. Somebody opposes the advance of the bulls. There's more volume, means that there's more trading going on back and forth. So fear is a powerful motivator. So the favorite place of bulls to stage an attack like this is when the herd all assume that something's going to occur. So this is maybe a little bit different from a breakout level. When everybody basically just assumes that something is going to happen, this is where we get some really interesting things. So low volume at a breakout level means the bears, it's almost like they're playing, who is that, what the Spanish, I can't think of the name of that dude that dresses really funny. He's got the red cape. He's got the swords. Oh, what's the name of that dude? Anyway, so waving the red cape, right? And then he just says, okay, on you go. And that's almost what happens when you get some of these low volume breakouts. What is the name of that? The bears are basically stepping aside and you won't get the benefit of their squeeze through the covering. So what may happen in a case like that is it's almost the price gets up to there, and unless the bulls pick up the baton and drive the demand, since they're not going to get any kind of accompanying squeeze, they may just sit up here and not know what to do. And then the bears may say, I've got you now. I have you now. Down it goes. So this could be a false breakout if you don't get decent volume. You got to get people in pain to get everything to move. You will also get more volume on big range bars. So if you see a big range bar, something where the price is just, moving a great distance, you're going to get more volume. And that shows an extreme supply-demand imbalance. In this case, if it's a red candle, a hell of a lot more supply than demand at that point. People stepping to the side and saying, no, thank you, no bid. Okay, got a few charts for you guys. All right, so this is the move that we had last spring. Notice the volume that we had confirming the breakouts. Breakout, look at the volume here. So back around the beginning of April, when we did get this move, look at this base that we came from. This was just deathly boring, right? So we sat there through 3 straight months of this, the whole first quarter of the year, just like basically going nowhere and trying to trade within a very small range. Well, range contraction like this, as you guys know, leads to range expansion. We didn't know which way it was going to go at the time, but all of a sudden the volume comes in and it says, oh yeah, I'm going higher. And so when this did happen, I said at the time, this was a signal, and I said, we have to believe it. There was a lot of people saying, oh, this is just going to be the shorts are just going to pile on here again at a higher point, and we're just going to drive it back down again. Because after living through something like this, you just get this loser mentality of like everything is just going to completely, you just get conditioned to thinking that any green candle is going to die. But I saw the volume coming in and I said, you got to believe it. You got to believe it. Okay, but notice all these breakouts here. So the price broke up to the next level, and then it got up to this level here, and it just said right through it. Notice the volume. You got to believe it. So volume confirms the move on the breakout, and then we did get the euphoria move here. Woo, 14,000. We're almost back up to the old highs. There's the volume on the euphoria, but it didn't last very long, did it? So when the market shows you what it's doing, believe it. So that's breakout volume. Now we get into divergences, and these are kind of interesting, and these are not always actionable immediately. These more provide a sense of just a level of context to what you're doing. What I'm talking about here is notice how the price makes obviously a lower low, and what's happening with the volume. What's happening with all the red volume? We had some big red volume here, and then it just continues to tail down. So as the price makes lower lows, we really have less and less volume accompanying that. And then we get breakout back up. Believe it when you see it. So it's a little bit of positive divergence volume. Now, normally when you say divergence, lower lows, and then we'd have some kind of higher high here, but that's not the way that we work this with volume. Here's another volume divergence, which is negative. So think about this one. We are blasting higher in price, okay? Big volume here. And then what happens after that is the volume starts to tail down. The volume starts to tail down. Notice the next big move here, even though it wasn't necessarily to the same level, much lower volume. So we had, this is not exactly a Class A divergence. A Class A divergence would be a higher high. And I do have another example of that to show you in a minute. So this is volume divergence. The volume is slowing down. And unless we have the volume to accompany the move, we're not going to go higher in price for the most part. Especially if we have a lot of bears in the mix. We've got to overcome them. if we want the price to go higher. Okay, here's a volume divergence negative. And this is an actual higher high in price. And notice how the volume is tailing down and is starting to go negative. And when it goes negative, believe it. Believe it. That was our first signal, really, that, and these aren't easy to catch. I mean, think about this. I mean, all the buzz that was going on here around Bitcoin making 20,000. And you're going to sit there and say, hey, we've got negative divergence. I think I'll short the market up here. Said no one at the time, right? Nobody said that at the time. So this is something where you're going to have to be extraordinarily objective to be able to catch something like this. Not easy to do, but this is a clear signal that we had volume divergence. Okay, failed breakout. Failed breakout. So this one is here. Again, this is another higher high. And we had decent volume here on this initial thrust up. And then we sort of go on nothing. And then the red candles are much bigger than the green candles in this area. So believe them when they show up. So this was I guess you call this a failed breakout. I mean, it did actually break out. It just didn't go anywhere. Got hauled back down as the negative volume kicked in. Supply overwhelmed demand at that point. The demand did not pick up, not until down here. And why did it pick up down here? Because the shorts got too excited. They loaded up too much, and they all had to unwind to the upside. This is how rallies get going. This is why I have to fight with everybody every time we do some type of, public YouTube. And I talk about both sides of it, bulls and bears and things like that. And somebody invariably will say, well, dude, if we just get rid of the bears, then the market would go higher all the time. Which I guess in one form of logic that makes sense, but who is going to sell it to you? Right? So unless you completely get rid of all the supply, right? If you get rid of all the float, that's one way for the price to rise, which is, I guess, Bitcoin's ultimate value play because of the fixed supply. But this is what happens on a short squeeze. Okay, next example here. This is where the herd gets it wrong. So this goes back to September. And as we were in this pattern, I said, okay, everybody in the planet is studying their chart patterns and is coming up with a probability and is looking long. Everybody wants this to break out because this was such a great thing back here into June. And everybody's saying, well, let's it needs to happen again. Let's get back to that again. And look, it's very human to want that. It's very human to want to return to those heady days of euphoria. So everybody's leaning in this direction. Everybody wants us to work in this direction. And all of a sudden, it just falls out the bottom. Notice the volume. When the volume shows, believe it. So the herd was getting it wrong there. Based on complacency. They're like, well, of course this is going to go higher. And then all of a sudden it dropped out of the pattern. And then all of a sudden you're getting all the BitMEX wrecked tweets out there. Because people are using liquidation as a stop loss. Oh, that's a bad idea. Now the same thing happened down here where, what do we have? Oh, it's a head and shoulders pattern. Oh my God, head and shoulders pattern. Oh, it's breaking down. I want to get short. And right around here, China said, we're thinking about doing that crypto thing. Crypto, like boom, short squeeze. So everybody that got short down here, all of a sudden, when the volume shows up, believe it. Believe the volume. Now, the problem here was, this is what happens to a news event which occurs over the course of 2 days, but still does not fundamentally change the supply demand. And that's typically what you have in a bear market rally, is you get these huge spikes up because the short interest gets too high down at the bottom. Big volume comes in, but it doesn't last. It doesn't last. They couldn't keep it up, and it just tailed down from there. So they got it wrong. The herd got it wrong twice. And that is, if you trade against the herd, for the most part, you'll be doing okay over time. Sometimes the herd will get it right, especially at the very end of a parabolic rally into euphoria, where everybody that's been trading for 2 weeks all of a sudden is an expert. So it's easy to be a genius in the very end of a bull market. So those are about the only times where the herd gets it right. The rest of the time, you're better off trading against them. So here's the herd assuming a pattern outcome. Here's another great pattern here. I love these. And that is supposed to, according to Hoyle, that is supposed to break to the upside. A significant period of time. I forget what the numbers are right now, but it's got to be in excess of 80 to 90%. And instead, it broke to the downside. So the herd was assuming a pattern outcome and getting it wrong. Notice how the volume will die down during a consolidation. Okay, so notice as the volume goes in consolidation, volume will die down. You can almost put a ruler on that. And as you get into the apex of the triangle, the volume should be very small. Very, very common. And then from there, it will break. It will break. Matador. Isn't that the name I'm thinking of? Matador? The guy with a cape? That's a matador? Somebody help me out here, because that's going to drive me nuts if I can't remember that name. Okay, so very normal to see that. The herd getting it wrong. And notice the volume. Again, we have the same thing happening here. We have the bears. They got the initial break right, but then everybody said, oh, it's heading down to zero again. Let's jump on short. And then they got squeezed out on big volume. Believe it when that happens. So a couple of finishing thoughts, and I will leave you to your Friday. Don't forget, in crypto's a little odd like this, is that the volume that you read is going to be for that exchange. For that exchange only. So if you read Bitcoin and it's on the Bitstamp exchange, that's the volume that Bitstamp is trading. If you're watching something on Bitfinex, that's the volume on Bitfinex. If you're watching something on Coinbase, that's the volume on Coinbase. Now, they'll pretty much be on par with each other, but some exchanges, you can go to coinmarketcap.com and you can see who's the biggest volume that's out there for any particular period. So other brokers might show more or less at the same time period. And lastly, don't short a dull market. Markets can stay in accumulation. We hope, right? We like this to get into accumulation mode for long periods of time. And a lot of people can say, oh, well, this is going to die. This is going to, and right now this comment is mostly pointed at the equities market, not necessarily the crypto market, because we're not in a long period of dull accumulation, even though that would be kind of cool right now. Maybe this will happen next year or later on this year. But at some point it will happen. We'll get into one of these long periods of accumulation, and the volume will tail down and people will say, time to short it. No, don't short a dull market. So maybe there's just no battle going on. Maybe the bears are just like, that's okay. Not interested in shorting it up here. Yeah, there we go. Matador. Thank you. Now we can sleep tonight. Okay, folks, let me know if there's any questions. So if you're watching this on a replay or archive, you can certainly email me any questions that you have on this. Maybe you've got your own views on volume. which differ from mine, I'm certainly open to those. You're welcome to, add to the discussion that's in the Discord room. We are just all folks that are trying to find some edge in a financial market. So there's no one way to do things. What I'm passing along to you today is just sort of my observations over doing this day in and day out for the last 15 years. So with that, unless there's any other questions that come in today, I'd like to thank you guys for attending Trade School today. Today, the 24th of January. We're almost into February. I think we have one more Trade School next week on the 31st. So we'll do that. Is there any good use of volume moving average? So there's a question that came in. Is there good use of moving vol? So what you want to do is moving average on volume is, what you're going to do is basically see whether or not is it going down or going up. That's one use of it. And the other thing to see is whether or not the volume is above or below the average. So if you're getting volume spikes that are above the average, and a typical average is 20 to 30 days to use on volume. So if you're getting volume spikes that are above average, then believe them. If you're getting volume that's below average, then you can discount that to some degree. All right. Okay, folks, that's volume. Part of price and volume. So watch volume, watch price, and believe it when you see it. All right, folks, that is it for today's Trade School. Thanks again for hanging out with me here today. Have yourselves a great weekend. I'll be in the room in and out. Take care, everybody.